Steve, thanks very much indeed for joining us.
My pleasure.
Top line, when you look at those numbers, they look very good, but there is that one-time gain. If you strip that away, what sense do you get? Is it still as positive as the top line numbers suggest?
When you look at the performance and you look at the key indicators of the stock, actually when you peel off everything else, it's still a good stock. However, there are few challenges within, especially given the fact that it has done a lot of expansion within the region. The East African Breweries International, you've seen its expansion in Tanzania and in Uganda. Also, you've been able to see that it's been able to offset one of the key assets, the Tanzania breweries,
right,
and be able to get back 20% stake of the Kenya breweries, which was owned by Sub Miller. So you can be able to tell that there's a lot of push in terms of growth and expansion that's going on.
Yeah.
That there's a lot of cost in terms of sales, in terms of expenses,
yeah,
and the numbers will have been better. The performance, I mean, when you're looking at the PE ratio, when you're looking at the liquidity of the stock at the market, when you're looking at the key value additions in terms of the market share, in terms of new services to be able to lock in the clients, they're good. However, the expansion has actually been done in such a way that it's actually eroding into positive book value returns at the end of the day, and we've been able to see that the polarity of the shilling and also what you call the forex rate issues have actually been key to it.
Yeah. So when you look through all that corporate action, do you get the sense that this company here is building a solid base from which there will be growth going forward?
We've been able to see that the East African market is actually untapped as far as the products for the EABL are concerned. And what I think in the long term they're doing, what is any farm with stature can actually do, building a solid base, being able to have key footprints across the region to be able to tackle so that they can be able to reach out to the relevant market. And you've been able to see that they've been able to segment different products and services for the different markets, for women, for youth, and for the general population. And you've been able to see that they're actually pursuing cost-cutting measures, and especially through consolidation of services across the region. Yeah.
If you were to pinpoint the key areas for growth going forward, because looking at these numbers, they suggest growth across all their major markets, and also a growth in both beer sales as well as spirit sales. But if you were to look at it geographically, Tanzania appears to be key here.
True, Tanzania is key, and I must say that they made a strategic move to actually be able to offload off the Tanzanian breweries 20% stake and be able to get back the East African, the Kenya breweries 20% stake. For me, I think it's a key strategic decision, given the fact that in Tanzania they've actually decided to grow their own sorghum to be able to cut costs, and then in terms of going forward, the aspect of being able to categorize the client need and client base in terms of new product innovation and reinvention. We've seen they've come up with new products, new beers. We've seen they've been able to improve in terms of sales, spirits, coming up with affordable drinks that can actually be targeted to the lower market. So we're being able to see that once they're able to stabilize and cut off the what you call cost of operations, and then they'll be able to actually now target the lower market, whose their main competitors are the illicit brews.
You raised earlier the issue around cost control. I want to ask you a question around that. To what extent do you think they've got this under control? We saw a 26% increase in this set of results, but at the same time, we also saw the company taking mitigating measures. So they're talking about growing their own sorghum in Tanzania as well as Uganda. Would that be enough, do you think?
For the time being, no, because we've been able to see they're still trying to streamline the operations across the East African region. We haven't put in the fact that they're trying to get into the Southern Sudanese market. We haven't put the fact that the Rwandese market. So for now, until they've been able to stabilize what you call return on assets for most of the key assets, then the issue of cutting down on costs will actually be a challenge to them going forward. And also the aspect of when you look at the debt portfolio, it's actually pretty huge. So that's another thing that actually they also need to look into it. But
this is also stocks trading around a historical price to earnings ratio of around 17 times. Expensive in your book? Would you be buying? Would you be accumulating? What would you recommend?
My recommendation, if you had the money, I'd buy and hold.
You buy and hold?
The fundamentals are key. It's good growth. When you look at the dividend yield, the return on it, it's impressive. It's one of the best in the market. It's actually one of the key stocks that anyone who had money will actually get into it.
Absolutely. Anyone who's selling Johnny Walker would certainly be worth holding, because you certainly
keep walking to the bank.
Steve Biko, thanks very much indeed for joining us for that.